Let's see how we record journal entry by using perpetual inventory system. Perpetual inventory system. That means we update cost of goods sold and inventory in real time. That's buyer's point of view section and seller's point of view. I just separate in order to make it simple to explain. Let's say July 1st, purchased $1,000 with FOB shipping point $100, free charge $100 with 210 net 30 discount rate. So, am I the buyer or seller? How? How do I know that? The verb purchase means I'm a buyer. Verbs are going to give you away what's your point of view. So you gotta be really careful when you read. Purchase $1,000 FOB shipping price. So how we record? We purchase inventory to sell, right? So increase inventory. Current asset increase, debit or credit? Definitely debit. So July 1st, date, how we record? Increase inventory. How much? $1,000. Then, what about credit? Cash? No. That's accounts payable. How do I know that? If it's accounts payable? Because we have discount agreement. We don't need to repeat. This is on account. If we already paid, we're not going to have this discount agreement. Am I right? So that's why we need to analyze. We need to read the instruction very carefully. So that's accounts payable $1,000. That's about the purchase as a buyer's point of view. And then it's shipped. Shipped. Who's going to pay for shipping? Shipping charge, who's going to pay? We have to read this one. FOB shipping point. That means free onboard shipping point. Seller's point free. Who's going to pay? Buyer has to pay. Am I the buyer or seller? I'm the buyer. So I have to pay and record. Alright? So cash, debit, and credit. What's debit? What's credit? Definitely cash out $100 and $100. What's the name of debit account? That's freight. No, that's inventory. I'm going to explain further later. July 5th, that's how we record, by using perpetual inventory system as a buyer. July 5th, returned. As a buyer, yeah, I'm not satisfied with the product that I purchased, and then I ask to return. So, how we record? Reverse entry. Purchase, reverse of purchase. Alright, so accounts payable opposite 200 decrease debit side, and inventory decrease 200. That's journal entry for returning as a buyer's point of view. And then I made a payment. July 9th. So definitely I paid cash. I don't have accounts payable anymore. So decrease accounts payable, then cash. How much? Accounts payable. Accounts payable. When we purchase, liability $1,000. We return, decrease $200. So balance I supposed to pay, that's $800. So $800 here? No. Why? Because we had the discount agreement. 210 net 30. So I purchased July 1st. I made a payment July 9th. I'm eligible for the cash discount. The discount. 2% off $800. How much is that? $16. Right? 1% that's $8. 2% $16. So definitely I have to reduce balance $800. But I don't need to pay total $800 because I had a discount agreement. So 716, that means 84, right? If we have accounts payable debit $800, credit cash 784, is that accounting? Accounting is all about keeping the balance between. I'm going to address that point many times. Once we break the balance, you don't need to go further. Why? Because 100% you're gonna get the wrong answer. You're gonna get the wrong answer, then you're gonna produce a wrong financial statement. You must stop over there if it's not balanced each other between debit and credit. So accounts payable 800, cash 784. Definitely we need $16 on the credit side. What's the name of the account here? Discount or something? No. Inventory. See? That's how we operate perpetual inventory system. When we use perpetual inventory system, if we are a buyer, when we purchase, when we need to pay based on shipping charge agreement, of course for return, of course for payment, only payment, for discount, we update only inventory account. Inventory account. Don't forget that. Why we purchase this one? Because we want to sell. So let's make a journal entry as a seller's point of view, and then I can explain buyer's point of view and seller's point of view at the same time. So August 1st, I sold $100. At the time, cost of $100 sales price was $60. How we got the cost? Cost calculation is not easy, very complicated usually. But for this course, as I mentioned, cost of goods sold is not just the only product cost, but also include everything, right? But in this textbook case, let's say the purchasing price of inventory as a cost. So that's given number. You don't have to worry about that. Under FOB shipping point $10 with discount agreement 110 net 30. Now, what's my point of view? Position? Seller. How we know that? This one, right? Sold. That means I'm a seller now. So I have to record this journal entry as a seller's point of view under perpetual inventory system. How we record? Increase revenue, increase asset, right? That's how we increase sales revenue, service revenue as well, right? So, increase what? Cash? No, we haven't received any cash. How do we know that? That's discount agreement. So, increase accounts receivable $100. Then increase revenue, sales $100. That's it? No. Perpetual inventory system. We update level of inventory and cost of goods in real time. How? By doing this. We have to prepare the second set of journal entries together to update the inventory and cost of goods sold. When we sell, we decrease the inventory, right? Inventory. Current asset decrease definitely. Credit. How much? $60. Now it's time to record cost of goods sold. That's product expense, product cost. Remember? Cost of goods sold and operating expense. So, cost of goods sold, $60. That's how we update the level of inventory and cost of goods sold in real time by using perpetual inventory system when we are seller's point of view. Okay? We accepted, one of my customer actually decided to return. So we accepted, return $20. Then we're gonna get back our product, and then we are going to sell it again. So put on the shelf again. That means reverse, right? Simply. Sales reverse how much? $20. Accounts receivable reverse $20. Good? Or that's a reverse entry for the first one. Second one, opposite, right? Inventory increase and put it back, and cost of goods sold decrease. How much? When we sell $100, 60% was cost of goods sold in inventory. When we accept $20, 60% of $20, that's the value of inventory and cost of goods sold. So $12. That's how we update the level of inventory in real time. Good?